Hello, and welcome to this week's Market Outlook. This is Jeff Fish, president of Engage.com, and I'm filling in for Keith this week for the weekly Market Outlook. Please be sure to weigh in on our market sentiment survey, which you should see at the bottom of this video. If you vote, give us your opinion, and also sign up for the Outlook newsletter. We'll make sure that we send you the weekly email that gives you the summary of the trader sentiment. So this week I'm going to follow up the article that you should have read right before getting to this video to take a look at how September might get started in terms of the market. Now, unfortunately, we don't have anything that is really decisive at this point. And what I mean by that is that if we take a look at some of the indicators that we look at on most weeks, you'll see that there isn't a whole lot that is at an extreme. So we're going to have to really rely on price action and be flexible in the first week or two of September as traders come back from summer vacations, reassess the numerous political and financial market developments that have occurred over the last several weeks in August. So let's take a look first at the Mcclellan Oscillator. Keith keeps you abreast of this almost every week, and there really isn't much to say. It's right in the middle of the range, and with market action, if we look up at top at the S&P 500, market action has pulled back, but McClellan's right in the middle. What we really want to see is the McClellan at one extreme or the other, and as long as it's not there, I wouldn't get too excited about it. Another indicator that we look at is the sum of the advanced declines over the last 10 days. And this too, as you can see, really isn't at any kind of an extreme reading. We like to see it over the line or under the red line and then come back above it. So until we move further, which would mean almost certainly we'd need more of a decline, advanced declines from this basic but powerful indicator is again not giving us any clear indication one way or the other. One of the indicators that is at an extreme is the VIX. Now, one of the ways we look at the VIX, as you know if you've watched this outlook with any regularity, is that we look at the VIX in a Bollinger Band. And when you get to the top of that band, it often means a short-term spike in trader fear. And we are at the top of the band. We're at a relatively low level, and we really haven't had much of a sell-off. So all that to me adds up to, yes, we're at the top. Maybe that provides a little bit of support for the market, but I don't think it really indicates any kind of a rubber band effect that would propel the market higher because it's gone down too much. The market simply hasn't gone down too much. The VIX indicator is only mildly indicating a bullish reading. So while this is the one that is the only one that's at an extreme, it's not so extreme that I think it warrants a whole lot of attention, except to say we should keep an eye on it if it continues to move higher, and if the market moves lower, it is in a position to easily spike to levels that are overbought, which would mean that the market could bottom. But there's no telling how far the market would go in terms of price in order for that spike to happen. So keep an eye on it. Don't get too excited by it. Now, the other things I want to bring to your attention are actually found in our little big view area of our website. So let me pull this in, and there's a couple of indicators that I want you to know that you should be focused on. All right, so I just went to our little big view area of our website. So you can find it under Resources, Little Big View, and I am in the Market Analysis section, as you can see, and I'm in the Charts section. Now, the indicator I'm focusing your attention on here is the new high, new low ratio. Right? It takes a look at how many new highs are being made relative to the total number of new highs versus total number of new lows. That's 52-week highs and lows that we're talking about. The way you want to focus on this indicator is to look at the trend. If the trend is up, then it's mildly bullish, and the extent of the indicator. So as you can see by the labels, if we're over 85%, you're in a bullish condition. Right? You're making a lot more new highs than you are new lows. If you're trending up, you're in a mildly bullish condition. If you're trending down, you're in a mildly bearish condition. I'm pointing out NASDAQ first because I want you to watch out for the fact of this rolling over and starting to trend down. That would be a negative, somewhat negative development in my mind, given where the market currently sits, and given the fact that the market has had a nice run up, but it hasn't enabled, or it hasn't had the participation of a whole lot of new highs. For example, let's take a look at what the same indicator looks like on the New York Exchange, and you'll see what the indicator looks like when it's bullish. With the Qs at new highs, or near new highs, you want to see this up in the 85 level. It's not there. If it starts to roll over, it's negative. That's why I'm bringing it to your attention. Let's go over to the NYSE. Okay, same concept, but for New York. So you can see that NYSE is up above the 85. Now once you get over 85, even over 80, it's hard to, you can't trend anymore. So you don't need to look for trend going up when you're up that high. What you do want to watch out for is if you come back down below 70. So for NYSE, we want to be careful about seeing this come back down below 70. For NASDAQ, we want to see the trend head lower. Both of those indications would be a significant warning of a market that is deteriorating. Now chances are, if that happens, the market will already be headed down. But what that will indicate is that the market heading down and those two conditions means the market's probably got more downside. Alright, so now let's take a look at the markets themselves. And what I really want to do for this video, to keep it relatively short for you, is to just focus on the areas that are the critical areas in the major market indexes. Okay, you've got a swing low that has been tested, was tested this week. All right, in every one of the indexes. So I'm going to focus your attention on that swing low. And essentially, I think we can, what I would describe as box the market in. You got the high we put in last week or the week before, and the test of last week. That's defining the last 2 weeks in August is really your key range. If we get above the last 2 weeks in August, it's going to be, time for the bulls to show up and really see this market run. If we get below the lows of the last 2 weeks in August, then it's going to mean more downside in the market, and you're going to want to look at those other indicators that I just pointed out, either to confirm that it's going down or see if it's going down too much too fast. As you can see in the SPYs, and as I highlighted last week on the longer term charts, we're up against significant historical levels. And if we break out from these levels, it's, as I said, time for the bulls to show up. I'm not as focused on that as making sure I cover, if we take out the lows, where can we look for support? And I think on the SPYs, you're going to start to look for support at these prior highs here. And in here, 138 level is also 137 level, also this 50-day moving average. Right, so I'm not projecting that we get down to the downside, but leading into this video, I said, where do we look to see if the September negative seasonal bias starts to take hold? It's under these last 2 week lows. With that in mind, let's take a look at the Qs, which I think are potentially really the key here. Even though it's highly weighted by Apple, the Qs have been the strongest. Qs tested this really important 67, 60 level on Friday and came right back. And now with September, we really want to see when traders come back, are they going to break that low of Friday and move lower? The reason I think the Qs are the key is because they don't have a whole lot of support until they get down to this 65 level, 65.25, and that's a pretty big and swift, potentially swift drop down to that 50 moving average. So that's what I'd watch out for in the Qs. Let's take a look at the diamonds now, the Dow. This has been the weakest both in terms of trying to exceed its top of the three we've been talking about, and also getting or holding, I should say, last week's, really the prior week's lows. It didn't. It broke it, closed below it. It recovered on Friday. But as you can see, this is the only index where you've got the 10 and the 20 moving average now negatively stacked. Your 10 has crossed. You can see it's coming down pretty hard, and that indicates that coming back up is probably going to be a little bit of a struggle. The saving grace, if there is one with the Dow, is that it's already down into a lot of support. But where we're looking at the 50 moving average on the other indexes as potentially the next thump down, the next foot down, if you will, I think on the Dow you have to keep in mind the 200. If we really get hit hard, it's the 200 we're going to look at. All right, but it does have good support, or should have good support, around last week's low, so I still maintain the last 2 weeks in August for the Dow too are the key levels. Just keep in mind the 50 is a lot closer. And also, let's just take a look at where this trend line comes in. Going to come in right around the. It's going to come in right around the 50 as well. So trend line from the lows. It's going to be an important level as well. All right. So let's take a look now at the last one, the IWMs. Alright, so the IWMs are, I like to describe them as in the process, trying to figure out which way they're going to come out of this wedge. I think that's the big picture you need to have with the IWMs. They're not sitting as nicely at a major high as the other markets, but it being the broadest index, we really want to see this one participate on the upside if the markets move up. And it's also been a pretty good indication that the markets weren't quite ready to go down, because its low from the prior Friday, from its Friday low from the 24th, wasn't even closely tested. Right? All the other ones broke it by a few pennies or more in the Dow. This one didn't really even come close. So the breadth, the broader market has held up better than the Qs and the SPYs and even the Dow. So I think this one is a pretty solid barometer of which way the market wants to go. The Qs may run ahead on the upside, the Dow may run ahead on the downside, but the IWMs are your barometer of which way this market's going to go. And the big number on the upside for the IWMs here is really this 81.86 level, and as I said, still that 2-week low, so that's about the 80 level. And just like the Dow, you've got a fair amount of support as it moves lower. So you've got the 50 to look out for and the 200 to look out for. But as I said, the takeaway here is where they're all trading relative to the last 2 weeks. All right, let's take a look at a couple other indexes. XHB, housing, continues to push higher. So if the market's going to maintain a bullish tone here, well, I don't think we have to say that this has to continue to push higher, but you don't want to see it fall apart. The chart here doesn't have any indication that it might. It's relatively strong. And so the concern would just be big red flag if this chart starts to fall apart. On the other hand, the SMHs are already back at their 200. They were weak to get started, weaker than the rest to get started. But like the Dow, they've got the negative 50 and the 200. So you've got the Qs as the strongest index in the tech, But the SMH, which is the semis, really isn't confirming that. So we want to see, again, if the market's going to go higher, we need to see the semis move higher. If the market's stalling and the semis are still falling apart, or deteriorating, I should say, that's a significant warning sign. Always like to have an eye on the financials as well. XLF has held up relatively well. It looks just as strong as any of the other indexes over the last couple weeks. So again, keep an eye on the XLFs. If the markets are doing nothing, XLFs have to maintain a bullish tone. As a side note to XLFs, KREs, the regional banks, have held up pretty well as well. All right, so keep an eye on them. Lastly, let's take a look at gold. All right, I did a little bit more with gold last week. I'm not going to do much with it this week, other than to just point out the major breakout that we have as of Friday. And there's probably a couple of ways you can look at this gold move. You could look at it in terms of the stimulus is expected. That's going to goose gold to the upside, in which case that's probably a positive for stocks. On the other hand, you also have to keep in mind that gold could kind of shift and become a place that people are running to if they think that there's some bad news about to hit. That's going to be bad for stocks. Either way, we need to be watching gold. Major breakout, and should be interesting for anyone who's interested in trading the metal. All right, so the message this week is really watch those last 2 weeks. This first week of September is going to be the week where traders come back and try and sort out what the summer has left us with for the fall. And as I said in my article, that leading up to this video, September is a pretty interesting month historically, and I'm sure it will be interesting this year as well. I hope that helps, and we'll see you in the next video.